All right, guys, January, what is it, 11th or 12th? I forget. January 12th, our second Edge meeting of the year. Eventually, we'll take these meetings and start uh, putting them into groups to make it maybe easier as we get so many of them for people to go through, like exercises would be in one area and stuff like that. But for now, we've been able to stay pretty sequential through last year and this year. I wanted to touch on something that came to me yesterday, and it was other time frames. It's obvious that most people are going to trade multiple time frames, either in this group or outside this group. Everyone has different styles and personalities and their goals of what they want to take out. However, most people are not great at understanding what other time frames look like, feel like. Heck, they're not even good at understanding what their own time frame feels like. It's important to know what the short-term guys are doing no matter what time frame you're in. It's not as important to know what the other time frames are doing if you're a short time frame guy. It's important, just not as important. The reason why it's very important if you're a long-term trader, medium-term swing trader, position trader, to know what the short-term guys are doing is because it will highlight better locations for you to execute when it comes time for you to execute. And there's always going to be a when you need to execute, whatever your time frame. Longer time frame guys trade fewer, make fewer trades, right? So their entries and exits are fewer and further between. But yet when they have to make them, why not give yourself the best chance to pick the best location? So understanding short time frame guys is very important to executing longer time frame ideas and trades. The reason why the short-term guys isn't as important to know what the long-term guys are doing is because we have a lot of short-term, or I would say, not I would say, you would have thinner slices of what you care happens. You could get stuck by not knowing that a larger time frame is going to puke a position. That's why it's helpful to know other time frames if you're a short-term guy or girl. But because our ideas are so compressed, that there's a lot of opportunities that the other time frames aren't even interested. If you're a longer time frame guy or girl, short-term guys are always interested. When it comes time for you to play, short-term guys and traders are always interested. But longer time frame guys aren't always interested for short time frame ideas. Hopefully that makes sense to you. If it doesn't, watch the recording and re-listen to this preview or introduction to this other time frame session. Let's move along here. I've got a couple cool things to show you. Let's jump over to knowing your time frame. I'm not here and the Edge is not here to pick a time frame for you guys to trade. You got to know what time frame you are. First of all, periodicity. Don't read all of this. I usually fly this stuff in. Don't read all of it. Just start here at the top. Periodicity equals your time frame. Okay. What is periodicity? Well, it's just the time frame of charts you're using. You guys are familiar with P&F now because you're in the Edge community. A 4 P&F, which is a popular short-term time frame, is going to obviously indicate you're a shorter term trader or you're trying to focus on what short term guys are doing. A 10 P&F or a 15-minute chart would be more of a swing trader looking at what the helicopter guys are doing. And a 60-minute or a daily chart might show you what longer term guys are doing, multiple days, weeks, investors. So your periodicity is going to equal your time frame. If you want to look at what investors are looking at, they're going to look at longer dated time frames. They're going to look at what 60 minutes dailies and weeklies look like, right? They're going to be focused more on that than a scalper would. Okay, and the scalper is going to know what a 4 P&F looks like and not care as much about what a daily looks like. They might take a peek at a daily from time to time like we do, like I do, but they're not going to stare at it. It's not going to be their main chart, right? So know your time frame and know what time frame guys, what periodicity is going to fit that time frame, all right? So I'm not going to spend a lot of time on this slide, And this session is not to pick a time frame and style for everyone. You guys have to do that yourself. But you just got to get better at getting an idea of what the other time frames are feeling and what they're doing. So I created this next slide that you guys have maybe in the trading room heard me say in the past, but I've tried to create more of an illustration to focus in on what this means. Here's just a splattering of a bunch of guys, emotional traders, column traders, and whatever, right? Well, let's put them into rooms like we've done in the trading room before when I've illustrated this. If these are rooms of people who are long-term investors are in the top two slides or two boxes right in here and here. Now stay with me on this. Medium-term guys are in these two rooms in the middle, and short-term scalpers are down in here. The column in the middle is the hallway. You're in the hallway if you're flat and do not have an open position. If you're in one of the rooms on the left, you're short, not physically, but in the market. And you're also a buyer, right? All shorts are now buyers to cover that position. Hopefully at this point you guys know that. On the right side are longs and people who now have to sell to get out of that long position. If you own a stock, you're long. You're now a seller. You might be a seller today. You might be a seller next week. You might be a seller in 10 years. Your family might be a seller after you're dead because you gave them your stock holdings. Either way, someone's got to sell that at some point. So here's the rooms and here's the columns. You're flat in the middle or the hallway. And these little doors have people going in and out all the time. Our job as traders is to know which rooms might be more crowded and which ones have the when does this guy start to look like this guy scenario. So again, when does this guy start to look and feel like that guy? That's where the exodus happens. That's where the guys flood out of the room and into the hallway. If guys are flooding out of these rooms in here into the hallway, there's a lot of selling pressure on the market. Longs are exiting, which we've had a lot this year in the first week and a half. You've had a lot of people up in this room, which are long-term investors, okay, have left this room and gone in the hallway. They've sold their position to help put pressure on the market and keep pressure on the market. See, you understand something, is when people that are in a position, and stay with me on this one, when people are in a position and they cover the position, they're no longer a buyer or seller. Therefore, they're not going to create a potential reversal. What do I mean by that? Well, if you're in the hallway and you get long, you're a buyer to get long. But now you're a seller to get out. So you're a buyer to get long, great, but now you're turned into a seller, not so great if you want prices to go up. Make sense? But when someone with the position gets out of the position, so when a long gets out, he sells it, he's not a buyer anymore. He's nothing. If he sells a long position to get short, that means he reversed. Now he's a buyer. But when people exit a position, they're nothing anymore. And that's what you want if you're looking for follow-through. Because you don't want a seller to turn into a buyer right away if you want the market to go down, because you just created a buyer in the market. That's not good. You want sellers, if you want the market to go down, just for example's sake, if you want the market to go down, you want longs to puke. And you want longs to try to puke and not be able to, so then they remain sellers and keep pressure on the market. But at least when they do get short, at least when longs do get out, their selling doesn't turn into a potential buyer below. That's what's important. You have to have this visual or understand this dynamic like the back of your hand in order to start really getting into reading charts in a reactionary state. You hear me say in the room a lot, who's swearing? So if you're in this hallway, you're always in this hallway. Even if you're in a position, you better know what room you're in, but you also better listen to other people in that room, and you have to pretend like you're in the hallway. That's the only way you're going to be objective in a very subjective state. That's what's hard about this business. How do I make objective decisions when I'm not objective? Because you're not objective if you're long or short. You're bearish or bullish. You're not objective if you got money on the line. The biggest thing to make us emotional are two things: when your life is in danger or when your money is in danger, and your mind doesn't know the difference. When your life is in danger or when your money is in danger, your mind doesn't know the difference. That's when you're going to be the most emotional in your life. So in trading, it's your money that's in danger when you have an open position, even if it's a winning position, because you're always going from high profits to smaller profits and such. It's not just losing positions that people get emotional. It's any position, period. So you have to think like you're in the hallway, even if you're not, because this is where you should be. Let me get a nice color pen here. This is where you should be mentally as much as you can, even when you're in one of these rooms. Now remember, these rooms on the top are longer term investors. These guys in these two rooms on the right and left are medium term swing traders, and at the bottom you could call these guys scalpers or shorter term day traders. All right? 3 sets of rooms. The rooms on the left are always people who are short but now buyers. People on the right are longs but now sellers. Got to know why they're sellers, right? You guys got to know why a long would be a seller and a short would be a buyer. Goes back to, I think, one of the first videos in track 3 that says after you buy it, you're a seller. After you sell it, you're a buyer, right? So we get that. In the hallway, when do people who are calm start to say, holy you know what, this sucks. This position stinks. This business stinks and everything else. That's if there was audio, that's the audio you want to hear to start to find good locations. Because if you're hearing that kind of audio coming from this room and coming from this room, then this damn market is going down. And if you're bearish, that's your best chance to get short. If you're hearing guys that are medium-term longs and short-term longs both start to say this stinks, and they're collected in the same area, because that's the selling, and these guys are going to rush out of the room, rush out to this room, and be the sellers that make the market and prices get hammered. You notice that when people are calm, doesn't mean they should be. That's the other thing, is if you look at someone and they look calm, it doesn't mean they should be. That means that they're in the back of the room and someone's going to yell fire, and they're in the back of the room and they're stuck. At least this guy, he's nervous. He's positioned himself at the door. And that's what we have to do. It's okay to be wrong, but know where the hell the door is, finally. Know where the door is, which is your exit. Yesterday in the team room, I said, man, I'd like to sell these 07s. I remember the price, which would have put me in this room. Okay? And I said, I said to George, because he was there, I said, well, where am I wrong at? And as I'm asking him, waiting for an answer, I'm also looking at the chart. And I seen that I was wrong, like, I don't know, it was like 4 ticks away for whatever reason. I don't remember the reason. But I was wrong. If I got short at 07, I was wrong 4 ticks higher than that. That gave me confidence to get short. 05 was where all these longs, all 3 of them, were going to run out in the hallway. There was no question in my mind. So I said, if I'm 2 points away from a really nice winner, I could risk that. And it gave me the confidence to say, let me get short, because I do really think that everybody on this side of the hallway, almost all 3 categories are going to start. There might not be a lot of people that leave here. Hey, listen, if a lot of people who are long-term investors all exit, that's called capitulation. That's some 2008 type of selling. You don't need everybody to exit. But if you get everybody to exit that are short-term longs, some of these guys and some of these guys, that's a huge sell-off in the S&P. And then that becomes the foundation, and more than the foundation, for reading a chart and creating a better bias than you did in the past. And to be objective after you created the bias, even though just by its very definition, a bias isn't going to keep you objective. It's your opinion. How the heck could you be objective when it's your opinion and you're going to be wrong a lot? So how could you be objective when it's your opinion and you could be wrong a lot, and it don't feel good to be wrong and everything else, and yet you got to keep a clean head? Hard to do. That's why the sky's the limit with how much money can be made if you're good at implementing what you practice when the money's on the table, when the cards are out there. And the chips have to be pushed in. When you push in chips and then you have to say, I'm out. It's a very hard thing to do when you play cards, is to automatically say, I'm out. Or automatically say, I lost this hand and I'm going to lose money. It's a way to not throw good money after bad. It's essential as a professional card player, and it's equally important as a professional trader. That's exiting losers. But if you don't know where you're going to get out before you get in, you're not going to ever be confident getting in, and you're going to be bad at getting out of those losers. It's got to be a predetermined idea. So keep this visual of the hallway as being flat and objective. On the right side, rooms of longer term, medium term, and shorter term longs, and on the left side, shorts. And what they sound like, feel like, act like. If you are a guy in the middle, you got to keep your ear, I'll give this guy a big ear, to these walls to listen to what they sound like. Take a peek in there. Heck, sometimes you throw a Molotov cocktail in there and burn the room out, see them run in and see them run out. I mean, that's what this business is. You know, you reach in this room, yell fire, and then run back in the hallway. It's what you're trying to do. In that case, you want buyers to come into the hallway because then the market will go up. So if you're long, you'd like to go into this room, go into this room, go into this room, and yell fire if you're long, because that's where the buyers have to come from to get prices to go up. Markets do not go up when people buy it. Markets go up when people try to buy it and can't get filled. They need that element in order to rise in price. They need people to try to buy it and can't get filled, but are still willing to buy it. That's how prices go up in any product, in any instrument, in any business. So where does the sounds come from and when does this dynamic happen is going to help give you better transitional moments and objectiveness. Now let's look at a chart. These are the charts you guys are used to looking at in the room. They tested the close of yesterday again. So what this dashed yellow line is yesterday's close, right? Now let's take a look at this move right in here. This is perfect that this is happening at this time. This is a transitional up bar. It's got all the shorts in here wishing they would have covered on the move back to 14 quarter. It's going to make it hard for it to go down. So we're probably going to go up, test something above 20 before we test something below 14 quarter, just based on this bar. This bar reminds me of this bar. See, this bar, when it started, it started fast to the upside, around 15.75 and 16 even. Don't worry if you're never going to trade an S&P E-mini. Don't worry about that. Price is price, buyers are buyers, sellers are sellers. So when it goes up fast in there, it had a chance to be a long up bar, it is. If it holds this thin spot, it's got some more good upside left to it. But at the beginning of this bar, you start to hear the noises and the swearing from the people on the left side of the hallway. Shorts. And if the yelling is coming from shorts, buyers are about to come in and you're going to get this upside like you got. Now let's go back a few beats. That's a industry term for professional writers. If you watched last week's session, you'd have known that. So let's go back a few beats. That bar I just showed you was this bar. And if you do your exercise and you say, man, the shorts are all aggressively coming in here. They're all, and you know that from the footprint, all this red. And then wham, this market goes up. You know you got the people on the room on the left saying, damn, why didn't I get out? Shoot. So then when you go forward, you could predict that the upside is the next right side. Especially when you hold this thin spot, you hold the close, and you get this bar to get fast in there. There's going to be more upside. Now, even though I know there was more upside, so it's easier for me to predict that, it's also something in your exercise that you could say you're not surprised it did that. Now, the first moment right there would give you a clue the upside might be over. And it takes a while, but the upside, my thing wasn't over. But you see where the top of the consolidation gets taken out, and it's right in here. After this down bar, it should keep going down. After a while, if it doesn't, it could go either way. That bar is indicative of lower prices. Again, chop sideways, should let out. If it gets below 19.25, bam, sell stops come out right in there. Do this on any time frame, not just on 4 P&Fs. And where are these guys going to swear and yell? So there's a couple of things I want to show you that's more in line with other time frames and other charts. This is the big up bar. It tries to rally up in here, comes back. This is the last hope for bulls to hold. This thin spot still has a chance to go up, but they're running out of time. They got to hold this thin spot. See where this thing got fast? If you combine these two bars where my cursor's going over, they're trying to hold it here, but they're running out of time, and there's significant sell stops. And people who are long swing traders are going to puke below yesterday's close. You know they're going to puke below yesterday's close. That's the rooms on the right. Why are they medium term? I'll tell you why they're medium term. Because they're looking at data that happened back here and here. You could see a test of yesterday's close. Maybe they held on to it. They held on to it here. If they come back down in here, there's significant sell stops below 13.14. Now, let me show you a 30-minute chart, which who's going to look at a 30-minute and a 60-minute chart more? More swing traders, right? Because those are the time frames that fit their hold times. Take a look at what they're looking at. This is what they're nervous about. Everybody's nervous about something. Let me change my pen color. Everybody's nervous about something, whether you have an open position or not. If you don't have an open position, you think, why would I be nervous? Because you're nervous with anxiety of when you are going to get in. So you're always nervous. You're always a bit subjective. Always. Where are the people who have positions on nervous? Look at the swing lows that are starting to get created in here, and a little bit in here. These are 30-minute lows. You need to have those written down and know that the market was tested once, it was tested twice, and it was essentially tested 3 times on 30-minute charts. You think it's troubling for longs if it gets back down to 1900 again? Of course it is. Of course it is. Especially given the context that we got all the way up to 40 even today. Now I'm going to come back and give all that strength back. All that success gets taken back. So that's a medium term where they yell, swear, and everything else. So if you're a long-term guy or a short-term guy, it's good to know where the medium-term guys, where they're sweating, where they're mad. The medium-term shorts are really going to get nervous above all these swing highs. Just keep it simple, which is way up at 60. Some of them were nervous, but these are only from one day through there, right? And that's why we extended with some follow-through once we got above 29 even. That's why 29 evens became a line in the sand. Do you see what just happened through those 16s and how some of the medium-term swing traders are going to say, they've held on too long. How you go from it's okay to have a transitional bar up to say, okay, shorts are in trouble. It's going to be a while before they can go back down. Here was a while. Then they go up, bam, right back down. And now they're going to attack this swing low and that swing low. But hold on. Let's do this too. Let's turn this into a daily chart. This almost feels, guys, like the '05 evens felt yesterday. It was a little later on in the session. It was like mid-afternoon. But this area felt like '05's did. All right, so this is a daily chart. Looks pretty ugly for investors, doesn't it? Now, take a look at this. And this is this is important. These were important areas to know as a short-term guy even, but definitely as a long-term investor. Look at this, the 13, 14. This downside is not like a super surprise, this latest move. There was a transitional moment up, boom, they took it back. And now it's like, wow, if I'm long, how many attempts to hold 14 do they have left? And you see how quickly they then move through 16, 14 and make these 11s achievable. This is a daily chart. Let's stay on the chart here now. Don't you think that these swing lows and this box you could draw around the S&P on a daily for these guys are nervous below there? And you can kind of get a sense that, hey, this is a test. Sure, this is a test. This is a test. This is a test. They go through it this time. It's probably gone. This can't be a surprise. This cannot be a surprise. This move right in there after all these swing lows. Some people might say, well, why wasn't it this swing low? Well, because it took a long time between we had it, they had it hit there. It took a while. Let's get rid of some of these. It took a while. And then when it hits it there, it doesn't take a while to revisit it. Much more high probability that we're due for a big down day because all these swing lows can't hold. So you have to know they're in trouble below 1980. You have to know that. And who's in trouble below 1980? Longer term traders / investors. You have a better sense of price action when you know it's going to be hard to rally when you see them come out of a daily consolidation. All right. And then you take this up. What did we get down to? 10, 11 just now? I got a level at 10 half, 11 half. Just you guys that might be in the market now. This reminds me of when we used to have our meetings. We had a projector of a chart that sometimes we turn off because guys would be watching what the market's doing while someone was presenting or whatever. But these are downside targets way down here in the 60s, 1860s, and the 1821. Now, what's going to happen to blast through there is a big geopolitical event or one swing low comes up, comes back down, similar to this dynamic that happened around 1980. That's what's got to happen. It's got to test it down in here, come up, and then retest it. To know that puts you in a better position to trade it because you know what the longer term guys got sweat beating up on their foreheads. So this is a daily, all right? Let's take it to a 60. They bounced out of that 11 even. This chart's hanging on me because I got the screen share going. What was the low of that move, guys? Was it 11? It was like 10.5, I think. There we go. This is 60-minute, right? So each candlestick, or each bar, in this case candlestick, 1075 was the low. Thanks, Ellen. Each candlestick is representative of 1 hour in time. You could see the same thing setting up on a 30 as on a 60. These swing lows are very scary for longs. These swing highs were scary for shorts, and they did rally about 20 points away from these swing highs. No, not 20, about 10, 12 points away. But who's ultimately in control? It's easier to go down and go up. We know that. So it's easier to break out to the downside than the upside. But you did have guys get shook out. You got to know that. You did have guys get shook out of their short positions once it got through these 60-minute highs. You'll get shorts to get shook out through these 60-minute highs. Do you think you got longs to get shook out through there? Of course you did. They jabbed through it, came back, and then looked out and said, it's gone. Do you think that that's why it created resistance on there? Do you realize that? Is this a coincidence that this, where longs got shook out, created a baby bird scenario, and that's what set the top of this rotation right in here, between there and there on a 60-minute. You think that's coincidental? Of course not. Do you think that there's some buy stops above there? Of course there are. And then you could just take it through there. I'm just putting rectangles around consolidation on 60 minutes. This almost has got a 60-minute head fake. Look at this. If I draw a rectangle around this, it sneaks up today, comes right back in. If it can get through the middle of this consolidation, which it's working on now, they go after these 1900s and yesterday's low. It could get ugly. And this is what the longer time frame guys are looking at. The longer time frame longs are getting sweatier and sweatier, and will probably start trying to puke below 1900 even. Now, it's not easy to incorporate a scalping short-term trade around, through 1900 I'll sell it and life is good. You can't do that. But what you can do is create a better and more accurate bias to pick locations and be on the right side of the market. There hasn't been any kind of transitional moment up to get back into stocks. So let's say some of you traders you got out of your long equity positions. You hold some stocks, you got out of them, and you did it either when the unemployment number couldn't keep us strong 3 sessions ago, which was a great recognition of this market's weak, or the beginning of the year when China just created some massive downside and you played that as a geopolitical event to get the heck out because there was some legs and headwinds to these markets with China, whatever the reason. There hasn't been anything to say, let me get back in yet. In my opinion, there hasn't been. Like, there hasn't been that head scratch moment that would make the medium term or longer term shorts get nervous yet. Sometimes it's abrupt, sometimes it's not. Now, here's another thing that's interesting. Take a 60-minute chart of the S&P and you can compare it to 60-minute charts of other markets for other time frames, for other divergences. So for instance, let's take, this might screw this chart up, but let's see. Let's change the time frames here. This is 30 seconds. Let's take it to 60 minutes. Might have to show this another time. Might screw up the way this is overlaid with these other markets. All right, now let's change this guy. Oh, I got ahead of myself. While that's hanging there, look back at what we're doing through 11 even. There's no reason to say the shorts are in trouble with what happened after we bounced off 11. No transitional moment up or anything else. Let's see if we can change this now. It looked like it might have already. That's good. Look, all three of them changed. So this is the S&P at the top. This is the DAX at the bottom. Forget about oil at the in the bottom. All right. So this is the S&P at the top. Second line, this lighter green, is the DAX, 60 minute. Here's what's interesting, and this is somewhat advanced, but something to look at longer term if you wanted to pick more precise locations, is divergences on longer time frame. What do I mean by that? Well, you see how the DAX in here, see my cursor, makes lower lows, and you get this S&P plays catch up, then it makes lower lows and the DAX can't. So a lot of times this is because it's pre-market or after the DAX close and it gets a little cheap. But why doesn't it, if it let it down, why doesn't it re-break and go down when the S&Ps make lower lows? So on significant lows. And this market grabs a bid. Now it doesn't look like much, but it's a 40 handle rally. So it's like a divergence when a weaker market makes a lower, or a weaker market can't make a lower low when it should. S&Ps did. Then you go down here and the DAX doesn't. Now you incorporate another ancillary market, crude oil at the bottom, and you could say, today, look what it did today. We made higher highs in here. And you remember George saying in the trading room, but yet oil couldn't make higher highs. Other time frame traders in oil knows that they know that this is, you should understand if you're an oil trader that this is bearish. Why can't it go up to these levels? Look at my yellow pen. When the S&Ps breached their same levels, draw a line from there. See how the S&Ps breached their levels and went up in there after our open today? But then you look at the oil down here and you draw a line across and it couldn't really get that close. We mentioned that earlier, but that's a way to compare contrast. Now go to the 4P&F. Is this a transitional bar up? Of course it is. And you try to pick it off when you get all this green in here and all this speed. So instead of having to wait until you're trading 15 even, you know when it's trading 11 even, be careful staying short because we got some near-term upside coming. What does that mean for swing traders? Not much. You need some 30-minute highs to get taken out. So the 30-minute high in this bar, this is 60-minute rather, is 24.5. We're far away from that. The previous bar is way up at 26.75. So we're kind of far away from that too. No, I'm sorry, 30, let's see. Yeah, 26.75 last hour high. This hour high is 24.5. Some shorts will get nervous around the mid 20s based on that. Those are the last 2 hour highs. Let's change this to a 30-minute. You guys got questions? I've covered this in bits and pieces in the room and laid out and illustrated different things. Now you've got something recorded with better pictures to understand the dynamic of trying to fit and overlap the different time frames to create better opinions. You could try to do that as a profiler. I've always told people, try to find out what the profilers, are they really bearish or really bullish? And when they're wrong is where your opportunities are. Don't try to get really bullish and really bearish with other people. It won't work. Let them get real bullish or real bearish and where are they wrong. Always ask the question, not only where are other traders wrong, but where are you wrong at? It's easier to, trust me, when I tell you doing a trading room, it's easier for me to give a real-time opinion and not care about being wrong because I know when and where I'm wrong. So I don't have to say all day I'm bullish and damn thing is 20 points in my face. Never heard me say that. So it's easier to admit that you're wrong when you know where you're wrong before you even make the damn call. And make that part of your plan and your system and your strategy. Another thing I want to tell people in volatile times, these are great markets to trade when you've gotten good at watching other markets and reading flow faster. They're tough markets to implement the skills as they're happening. It's tough to trade fast markets when you haven't honed in on the skills to trade a market, let alone a fast market. So keep that in mind as you're at the beginning of this year and we've been nothing but volatile. It's good for guys that have honed in on the skills of reading other markets. It's tougher and riskier for guys that haven't. And that should be for obvious reasons. So take a look at this 30-minute. Just keep things simple. Simplicity. Where the hell do you think people who trade off of 30-minute charts are going to be wrong at? They're going to be wrong at where we started the 30-minute bar, number one, where we opened. We opened this bar, high is 18, and we opened it at 15.75. So we come back up to the open. Yeah, that could be resistance, and they defend that price. But right now, 18.75, that's the high of this bar. So if you got short in the last 30 minutes, you didn't get short roughly in the last 30 minutes, not exactly. But if you got short, you didn't get short any better than 18.75 because the last 30 minutes, 18 even rather, that's the highest we've been in the last 30 minutes. So if you're short in the last half hour, chances are you're short at 18 or below. Well, heck, this market went all the way down to 09 just now. So you'd be damn certain that shorts that are swing traders, still intraday guys, but guys who look for 5, 10, 15 points are going to get nervous above 30-minute highs because they're really getting squeezed. There's no way that they're short better than that. And I'm talking about the guys who get short over the last 30 minutes or 60 minutes. Keep it simple. And then have that fit your time frame to either get long or play short-term analysis to get you long if you're a medium-term trader like them. The other thing is, the more the market trades, the bigger your risk / rewards are going to be. So if you like bigger winners, these are the ranges you're going to get it, right? But you got to be able to adjust looking for 5-point winners when it's a 6-point range day. I think we're far away from 6-point range days with the volatility that we have. But my point is that fit your expectation with the ranges. We've had huge ranges, so you could expect to get bigger winners. But you're still going to have to risk a little bit more. You're not going to risk 3 ticks to make 5 points. It's not going to happen. So this is, again, a 60-minute or 30-minute chart. Let's open this thing. And if you just look at it, we know these three lows here are going to make longs really nervous. You got to fight through the middle of this range. You really do. The middle of a consolidation is important because that's like the 50-yard line. You're just talking yourself through this. It's like the 50-yard line. And it's also today's low. Or not today's low necessarily, but it's unchanged. So yesterday's close, the 50-yard line between these highs and these lows. So you also know that, and that becomes pivotal. It's the only that's the only Fibonacci line I like. Halfway backs are decent. Other than that, halfway backs and the fact that he's Italian are the only two things I like about Fibonacci. So a guy in here said to me, and I think this is huge and important to share, that looking for areas he wants to trade and then watching the domes and the relationships has exponentially increased his success. And he's felt like he's worked his ASS off, and he has. He's not just saying that to pat himself on the back. I know he has. And it clicks when you're watching the right stuff. And getting mad at missing trades is when you know you're getting it. But then go review what you missed. There's no surprise that we're getting it flickering on both sides of yesterday's close. My throat's getting sore. I know it's time to wind things down. This hopefully was a good session. It's not a specific buy or a specific sell session, but this is a session that you'll be able to have in the can to go back and watch, to work on just coming up with simplistic reasons why other time frames are long or short. I need to move somewhere from here. The older I get, the more I hate this climate. So this isn't just an important concept, though, to go and look at. This is an important concept to look at every day, to go over 30 minutes, to have depending on how many monitors you guys have on your workstation. I always have a click away for 30-minute a daily or anything else. I actually have them up on other monitors. But I also have them a click away to show the trading room. And my other monitors, I have a daily and a 60 for other markets. And that's how you do, if you're going to do your work, that's what you do your work. Where are these guys stuck? And you could create a worksheet. And I wish someone else would do this and share it. I don't want to be the only guy creating stuff and saying, do this, do this. The only way you guys are going to get good and stay good is if you kick some stones over yourself. That's why I'm like apprehensive to go over trading plan. I wanted to do so. I just went over a short-term trading plan for guys who understand scalpers. Guys got to come up with their own trading plans and put this all together. You got to make it, own it. But a worksheet that scaled or objectively came up with where other time frames are wrong. But if you don't understand what qualifies a time frame, you're not going to be able to do that. Intraday time frames are like two. There's swing traders, guys that'll hold on to positions for bigger winners. The bigger the winner you want, the longer the time frame you are. That's another way to qualify it. The bigger the winner you are, the bigger the risk reward you take or want, the bigger the larger the time frame and hold time. So one way to do it is the longer the time frame of the chart you're looking at, the longer the guy who's going to be looking at it. Russell's making lows, and we're going to break through this bottom consolidation. Look at this chop. This is a pretty clear bottom Sell stops at 13 even. Russell led it. They get through this green tempo that picked up where my cursor is. They've got another leg. They're staring at another leg lower. Now remember, the overnight low is down at 99. Regular trading session low is those 09s, and then 05 half for you guys trading today and this afternoon is another place to watch. 05 half. So that I challenge you guys to, this would be an exercise. I challenge you guys to create a worksheet that was simple, that had long, medium, and short term. And the short term worksheet you really couldn't fill out because you got to let the game start to know where the short term guys are stuck. All right, you got to let the game to start. You got to let the game start so these guys get stuck because they're not stuck. But longer time frame and medium time frame traders typically have a position going into a session. So before you go into the session, you have a worksheet at where they're stuck, where they're nervous rather. So there'd be long-term bulls and bears, short-term or long-term bulls and bears, and medium-term bulls and bears. You created a worksheet that you could just quickly glance at and understand where those levels are and picture the chart. You're gonna be a better trader. You're gonna have a better, cleaner, more objective bias. And then the skills that you have will help hone in on, will help implement the skills that you've honed in on and created. One thing I think will make guys successful or give them their best chance. You just don't know what that one thing is. It's different for everyone. It's a combination of everything, but it's that one thing that helps people click. It's the gotcha moment. I got it. It's not random. I think I could do this consistently. It's different for everyone. It's about knowing a lot of things, and it's that one thing that helps kick you in the rear end, and you got it moment. Figure it out. Kids that figure it out with school usually can get good grades in school without massive amounts of effort. For me, it was just doing what the damn teacher asked. And you have to do more, but don't do less, and you're ahead of everybody else. Learned that at an early age and always got good grades. Nobody believed it. I'm going to sign off first on the recording. If you guys got questions, I'll give you a few minutes to answer or ask them, and we'll go over them. But the recording is going to end now for this other time frame session.